Hey, if you've ever felt intimidated by the idea of investing or wondered how to make your money work for you, this episode is a must listen. Now, today on the Debt Free Dad podcast, we have a special guest, Jessica Perrone from herfiniq.com, and she is here to break down the basics of investing. Now, Jessica is passionate about empowering people to take control of their financial futures, and she's going to share her expertise on how even beginners can start building wealth through smart investing. Stay tuned. Hey guys, welcome to today's show. I am Brad Nelson, founder of Debt Free Dad. I paid off about $45,000 of debt, have been debt free now for more than 11 years outside of my mortgage. I've also helped thousands of other people save and pay off tens of millions of dollars with the work that we do here at Debt Free Dad. Now, guys, after listening to this episode, if you want to take your finances a step further, you're ready to take action right now. I want to give you a resource that's going to teach you how to start getting better results. Seriously, guys, in as little as 30 to 60 days. And I'll be sharing some details about how you can get started with that later on in today's show. So, hey, Jessica, welcome to the Debt Free Dad podcast. So good that you could join us today.
Thank you so much for having me.
Yeah, I'm so excited to have you here. And could you share a little bit with our audience and listeners here today about where you got your start in helping people with, personal finances, coaching, investing and all of that?
Oh, it's been such an exciting journey. But really where it started, and it's kind of counterintuitive, is growing up without wealth. Growing up actually in poverty, believe it or not. I'm the oldest of 8 children. Growing up, we did not have the money conversation because there wasn't any money to talk about.
Yeah.
The excitement we had was once a month going to the grocery store, loading up that cart and maybe requesting an extra treat. Like that was the extent of, the money conversations that we had. But I did learn some really important values from my mom, who was a single mom and an immigrant. So I know I'm using all these catchphrases, but it really is true. That is the foundation of sort of where I started thinking about finances from a place of not having that foundation, for sure.
Wow. So at what age did you really start kind of diving into like getting to where you are today? Was this a personal journey you went on and you were like, hey, maybe I could help people with this, or what did that look like?
So funny you should say it. I'd say it's a culmination of all sorts of mentors I've had in my life. So I'll never forget the first time I had my real paying job out of college. Okay. And I got my first paycheck, and I had a mentor at that time. His name was Don. And he literally took me to the credit union in the building and said, okay, what are you doing with your paycheck? And I'm like, what are you talking about? What am I doing with my paycheck? I'm paying off my college loans. I'm paying for my utilities, my apartment. What are you talking about? What am I doing? And he's like, no, what are you doing for savings and retirement? I'm like, what's that? So he literally, I'm so indebted to this gentleman forever. He showed me these pamphlets from the credit union and said, okay, this is the 401k and this is the employee stock purchase plan. And you really want to put about 20% of your income aside for these things. And I had no idea what they were for. And to this day, I'm like, how did I not know that a 401k was being invested in the stock market? Like, for whatever reason, I did not make that connection. And so it's all these little lessons I learned from life that came together for the courses. And then I did have a successful career in Wall Street afterwards, where, and it's really interesting because I was working for a fintech startup. And I realized I was working with all these Wall Street desks, and I realized I had to learn how to trade in order to be a better salesperson for all these traders. So I actually went on a journey to teach myself how to trade so I could understand what these Wall Street traders were doing. And I learned so many things, and people say that mistakes are sometimes the best ways to learn. And I learned so many mistakes. And in my courses, my before investing for beginners, and stocks and ETF simplified, I really take a lot of these mistakes that I made over time and simplify them so that people have an idea of just where to start when it comes to investing.
Yeah. And I guess that's my first question for you is, So here at Every Dad, our goal here is to help people. We consider ourselves the first table of like, you don't have any emergency fund, you don't have any savings, like you're buried in debt, you're paycheck to paycheck living, you have a lot of financial stress. Like we got to work on getting that stuff cleaned up. And then I look at someone like you, an individual who helps people with the investing, kind of that second table. Now that you have money, you've reclaimed your income. Now what do you go do with it? And I think
Yeah.
investing is a great way to do it. But where in your opinion, like where does investing fit into the overall financial plan? Like again, speaking to someone who's our listener, our typical listener, living paycheck to paycheck, has some financial stress, like where do you feel investing falls in line with some of that?
So that's a really interesting question. And there's two schools of thought on this. And the first one is just like how easy it is to start investing nowadays. People don't realize how easy it is. They think they need like $5,000 to start investing. And that's
Right.
not true anymore. And I feel like with the courses that I created, I actually go into the different ways that you can start investing. And then you can kind of choose what is the right fit for you. But the number one way an individual can start investing is just by contributing to their 401k, their workplace retirement plans. And that is such a wonderful way to get involved in the market. And I feel like there's a disconnect there. If people are like, really? I'm invested in the market with that? Yes. It's just a
Right.
managed fund. The monies that you are having deducted from your paycheck are going into these retirement accounts that are being invested for you based on your risk tolerance and your risk assessments. So it's a really great way to passively get invested in the markets. So that would be like just the number one way to do it, regardless of your situation. And a lot of these companies have matches. So if you are not taking advantage of the match, the company match, you're losing out on free money.
Yeah.
Yeah.
Yeah, I totally agree there. And I think that's one thing, if you are getting a company match, is to at least, hopefully you're in a financial spot where you can at least put in the match just to get them to match it. Because like you've said, Jessica, that's free money.
Yeah.
What do you say about credit cards, high interest right now? I mean, obviously with the way that the market is and the way interest rates are, I mean, credit cards are super high interest. Like, do you recommend people holding off on retirement and focusing on paying that stuff off? Or like, when it comes to debt reduction, is there a happy medium in your opinion, or is everyone's situation different?
So everyone's situation is different. And I feel like, regardless, your workplace benefits is number one, like, especially if there's the match. But frankly, credit card debt with those interest rates are ticking time bombs, frankly.
Yeah.
So when I talk, so in my Before Investing course, I actually talk about the financial ducks. And these are the financial foundations that you want to get in a row before you start investing. And just it's really just a numbers game. So a lot of financial advisors use a like 6%, on average 6% return in the market. Okay, so just think about that, 6%. But if you are paying a 20% interest rate on a credit card, that really doesn't match, right? You're not making
Right.
enough in the markets to cover your interest from your credit card. So just a sheer numbers game. So what I do recommend doing is there's four things basically that we want to do before we start thinking about investing. Of course, like especially outside of the workplace retirement plans. The first one is credit card debt, bad debt. Number one, bad debt. Now, there are conversations about good debt versus bad debt, and also looking at interest rates, right? So we really, when it comes to debt, and especially credit card debt is the number one bad debt out there. But if you have, for example, a mortgage that has a lower interest rate, that's also helping your credit score, because a credit mix does help your credit score and saves you money in the long run, then maybe that is a situation where potentially you would prioritize investing over, trying to pay back that mortgage that has a super low interest rate. So it really is an interest rate game at that point, if that makes sense. I'm sorry if I was.
Yeah, no, absolutely. So I think what you're saying is obviously attack credit card debt with a vengeance, get that stuff paid off, because that's an immediate return right into your pocket. Like that percentage rate, you can look at that and say, I get to earn that back because you're no longer paying that interest every
Absolutely.
every single month. So yeah, that is some great stuff. And then what about like, okay, I'm looking at investing. Is this something that like I do on my own? Again, you mentioned company 401k plans, but let's say like my company doesn't offer a match and I got to look at something independently, maybe like doing my own Roth IRA or something along those lines. Like, talk about how you navigate, I guess, all of the options that are out there. I mean, heck, you can invest with apps now that are very simple. And
Yeah.
sometimes it's like you have all of these options, all of these things that are out there. And sometimes I think people like get stuck because it's like, I don't know if this is the right one or if this is the right one and who to believe. So how do you navigate all that?
Okay, so in my before investing course, I kind of talk about there's two things to think about initially. The first one is if you want to manage your investments yourself or if you want to have someone else manage them for you. So that's sort of the first thing that you want to think about. And frankly, it's risky to try to do it all yourself, especially when you don't know what's going on out there. There is risk when it comes to the markets. So where I want to say this though is I don't want to dissuade people from trying to invest in single stock names if they are interested in doing that. Just know that to do the research behind it and really understand the stock before you do it. Because if you're just following a meme on TikTok or a buddy's stock tip, you can get screwed. So let me tell you a funny story actually about this. And this is one of the lessons that I learned over time. Is again, in that first job that I had, I was surrounded by men in cubicles. And these guys in cubicles were talking about all these stock tips that their brokers were coming to them. And this was before it was free to place trades through your retail brokerage. And you actually had to call up the broker and place the trade and whatnot. And I'm like, and they're like, Jessica, you should really get in on this. And I'm like, okay, I will. But what I didn't understand is that news moves the stock and that opportunity is sometimes gone. So what I ended up doing was calling up the broker. I had to set up the account. A week goes by. I transferred money in there, which was a whole lot of money for me at the time. And it was a pump and dump scheme. So that means like the brokers were hyping it up, getting it to go up, and then started to sell it off once it reached the top. So I bought it at the top and it got sold off. And I it was a penny stock and I lost my shirt on it. I lost every single penny. And not only that, but I had to pay, get this, brokerage fees on top of that. So yeah, so that was like my very first lesson with penny stocks, but I didn't know that I was getting involved in biopharma penny stocks. I had no idea. Now I do. Now I know that there's different types of riskiness in different types of stocks. So you have your large cap stocks, which are like your Walmarts and your Microsoft. These are companies that will be here tomorrow. These small caps, these are companies that are in experimental phases. They don't necessarily have revenue. They don't necessarily have track records. So when you start thinking of these stocks in terms of companies, and that was another, another connection I made later on in life. I don't know why. I just couldn't connect a stock with a company. Like, it seems so simple now. I'm like, but way back when, I had no idea that a stock was just a company. And I literally, when I was going on my voyages for trading, I went through like all these stock screeners and I went through all these strategies. And then I realized, I'm like, you know what? I'm just going to invest in the stocks that I believe in. And that was one of the strategies that I teach a lot of individuals out there is just, sticking to names that you believe in full-heartedly. And Warren Buffett even says this. He says, do not own a company that you do not have intentions, and I'm paraphrasing it, for 10 years, of holding for 10 years. You do not have the intention to hold it for at least 10 years. And that's sort of like the thought process that you want to go through when investing in individual stocks. Yeah. I'm sorry I went down a rabbit hole. As you can tell, I'm really passionate about this stuff. Yeah. But so that was the number one, going back to what you originally said, the first thing you want to think about is whether or not you want to do individual investing or have someone else manage it for you.
Yeah. What do you say to the individual? Because you are very educated now with this, but obviously the average person doesn't have nearly the knowledge or the education that you do. And you brought up like things like brokers were speaking up these stocks. And obviously in this day and age, I mean, information is at our hands immediately. It's instant,
Yeah.
whether it's from coworkers, friends,
Yeah.
family, talking about investing, stuff that you're reading on social media, the news. Like, how does the average person sift through all that information? Or maybe, I guess the better question is, how do they keep their blinders on? Like, once they have a plan, they've set it up, whether they're doing it with an advisor or they're doing it on their own. Like, how do they ignore everything that's going on and just stick with it? Because I kind of look at it like a roller coaster ride. Like, how do you not jump off when it's like that big hill's coming and it's like, I need to stick to this? What are some suggestions there?
When it comes to managed accounts, that's somebody else managing your account for you. That kind of allows you to set it and forget it and really not have to worry about the ups and downs. So this kind of comes back to the different ways that you can invest your money. So you can invest it in a retail broker and invest it yourself, do the self-directed investing, or you could even do a robo-advisor. A lot of financial advisors won't take on clients less than $5,000, $500,000, $1 million, right?
Right.
So the robo-advisors really democratize the ability for an individual to have a service similar to a financial advisor, but not have the one-on-one touchy-feeliness. And frankly, if you only have like $100 that you want to put in a robo-advisor, you can do that. And there's 3 robo-advisors that come to mind. The first one is, excuse me, Wealthfront, and then there's Betterment, and then there's even Acorns. So Acorns is kind of cool because you can like round up your change, you can create family accounts, and it's really friendly and approachable. And I really love the education that comes with Acorns as well. They send you little blurbs every week about what's going on in the markets, how it affects you, and they're really approachable. So I've had a really good experience with them. I also really love my Wealthfront for more advanced robo-advisor, and they have some really cool features there as well. A lot of these robo-advisors allow you to take a risk analysis, a risk tolerance questionnaire, and then based on your risk tolerance, they kind of get an idea of how they're going to invest your money. So risk tolerance is basically like, how much risk do you like to take on? And I'm going to equate this to driving a car, and you're going to be like, what? So it's like some of us like to go a lot faster than the speed limit, and we're willing to take on that risk, right?
Right.
And some of us like to go the speed limit because we want nothing to do with tickets or any risk, right? And some of us were like, you know what? I'm going to go a little bit below the speed limit here, right? I'm really super conservative. I'm really scared of driving. So that's really what the robo-advisors and financial advisors are doing with these risk assessment questionnaires, is they're just gauging your risk tolerance so that they know how risky of assets to invest your money. So for example, if you are like, you know what, the market goes down, I have my blinders on, I'm not going to worry about it, and I have a long time before I have to go into retirement or take money out, then they might put you in riskier assets that might have a higher return. Whereas someone that's closer to retirement or closer to a life stage where they need to take money out, well, they might be in less risky assets.
Right.
So it all depends on, and this is so funny because you probably never thought that financial advisors and robo-advisors invest your money based on your feelings. Isn't that funny? Like,
it is. And that's why I like that you're talking about this, because again, I'm 45. So for me, I feel like I'm willing to take on risk because I got a while. But I think what I think people get wrapped up in is like, say you're like a 30 something or a 20 something, and you're so scared about getting into the market because of all of the uncertainties in the world and economy and possible war and all that stuff. And it's like, well, if you look at the grand scheme of things, though, when you're younger, like you have so much more time to come back from anything that might happen in your younger years. So I like that you bring that up because I think it's important. Yes, it's important for a financial advisor to weigh that, maybe a robo-advisor, but it's also important for you to understand that too, because you're going to see all this flashy stuff online or newspapers and friends and family talking about it. Like, you got to get out of the market because you're going to lose all your money. But as an individual, you need to understand, like, this is how it works. And I need to understand like my time horizon. I got time, or like you said, I might be an individual who doesn't have a lot of time.
And really the game here is consistency.
Yeah.
It really is.
I
And it's
love
not,
this. Yes. Talk
it's
about that. Consistency is so key. So consistency, like talk about like the importance of consistently doing this all the time.
absolutely. So, and there's two things that I'm going to talk about with this, but the consistency is really important. So, a lot of people say, okay, I have to wait until I have $10,000 and then I'm going to put in the market. Well, that's actually not the best idea because you look at the stock market as a chart, and over time, it's kind of zigzags. It goes up and down, up and down, up and up and down, up and down. But over the long term, it goes up, right? So if you put in money into the market, and that's another reason why your workplace deductions are so helpful, is because it's consistently being deducted and putting into the markets. And when you do that, you actually get the you have your monies invested in the market at different levels. So, for example,
Right.
on one investment, it might be kind of on the high side, but on another day, you hit it right at a low, and it averages out the cost of getting into the market. So that's also really nice.
Yeah.
But going back to what you said even before that, is the fear factor, and I just want to reiterate, we had the biggest financial event happen to us in our lifetime, which was COVID, right? We were cruising along, and then all of a sudden, the markets went boom. Okay, they sold off significantly. And a lot of people that were stressed out in that point in time took their monies out at a loss, right? They took their monies out at a loss. And to add insult to injury, they missed this huge rally afterwards.
Yes.
Right?
Yep.
So that is what fear does. And if
Yes.
you just consistently, you know what? This is a blip. I'm just going to keep putting my monies in consistently. You know what? Come back and you're like, wow, look at this.
Yeah.
Look what happened.
It's always so fascinating to me that people look at the stock market that way, as like, I bought highs, so things are good and my confidence is high. But like, if you go shop at your local department store, are you going to shop on the day where the product is the absolute highest you can ever buy it? No, you're going to shop when it's Black Friday and everything is 75% off, right? But it's weird how when it comes to the stock market, we don't look at it that way. It's totally weird to me that we don't.
Absolutely. And it's interesting because so I also wanted to, I'll just back this up really quickly. Another thing that people don't understand is that you don't have to do it, invest in the market just one way. Okay, so you can actually diversify how you invest in the market. You can have your own account, and a lot of us understand certain industries, and we have sort of this inside knowledge base. So especially your passions, like if you know cars really well, and you know that this type of engine is being used in these cars, or you can kind of get an idea of, oh, this is gonna be big, and maybe invest in that. So like you can have those individual investments. You can have a robo-advisor, and you can also have a financial advisor, and you can have a workplace retirement account as well. You can have all these pots. And what I like to do is I actually like to benchmark them. And if my trading is not doing better than my financial advisor, then why am I doing it? Right. Why am I not just allocating more money to my financial advisor? The other thing I just want to back up here is that diversification across asset classes is important. So, for example, don't underestimate real estate in this whole equation. And a lot of the things of real estate also apply to the investing financial docs. Like you really want to have a super good credit score going into housing. You want to pay off a lot of your debt as well. You want to have the emergency fund, and you want to be able to budget for it. So like all these similar conversations can apply to multiple asset classes, not just the stock market.
Yeah. Yeah. So good. So if you're just getting started, now you have some resources and things, and you've shared a lot of great information here just from like a 30,000 foot view of investing for beginners. But what are some resources and things out there for people who are looking at doing this, wanting to get started? what do you offer people, and how do you help people kind of navigate this big, huge subject?
Sure, sure. So it's funny enough, I started off with her financial IQ because my focus was women and teens. And I was just, it just morphed. I actually started like thinking I wanted to teach women how to trade. And the anxiety behind that was so great. I was like, you know what? I need to just teach women the basics of personal finance so that they feel brave enough to go out and have a conversation with a financial advisor or be part of the household conversation around investing. So I do have my courses for women. It's Before Investing, which talks about how to prepare yourself financially to start investing for beginners, which teaches you about the various ways to put your monies to work. And sort of when you identify the ways that you want to put your monies to work, you kind of have to identify what kind of assets to do that. And so that's why I came together with the Stocks and ETFs Simplified course, which really explains, what these financial advisors, what these robo advisors are investing your monies into.
Yeah. Yeah, I love that. So where can people get more information about where to get these courses?
Oh, thank you so much. It's her fin, like fin of the fish, IQ.com. Social media, I'm always posting things at her fin IQ, is all across all the social media, TikTok, Insta, Facebook. But I also do coaching. I do family coaching as well. And it's interesting because I had a lot of men approach me, say, look, we want to learn this stuff too. It's expected. We are expected to already know this. And
Yeah.
in our
Mhm.
family, but in our families, our dads didn't know how to do this. So it would be really nice to have
Yeah.
someone to talk us through this. So I do coach all family members, whether it's teens, dads, moms, couples, whole families together. So that's what I do,
Yeah.
and I love
That's
it. I
yeah.
really love every minute of it.
So awesome. And if you're listening to this and you're like, listen, is like, this seems really overwhelming. You guys, this is what we're working towards here. We're trying to get you out of debt into a better situation where you reclaim your income. And this is where it gets exciting because you get to take advantage of something called compound interest, and having interest be a benefit to you and your family and your future, and being able to build net worth and be able to reach your financial dreams. This is where the fun stuff happens. So get a hold of Jessica if you want more information. Thank you so much, Jessica, for this. This is great.
Thank you so much for having me. I so enjoyed our conversation, and I look forward to more to come.
Now, guys, if you are ready to take control of your finances so you can begin investing and taking advantage of this amazing thing called compound interest, I got a great resource. If you want to pay off debt, save more money, take better control of those finances, and start seeing better results in as little as 30 to 60 days, all you have to do is head over to debtfreedad.com, click on the green button at the top of the page, and we're going to show you how you can get started. Thanks for joining us on today's show, and we will see you guys on the next episode.